index funds, mutual funds, and ETFs. You've probably heard this word somewhere, on social media from influencers, friends, or even your smart uncle. In this video, I'm going to teach you what these funds are, with simple and practical examples. Before we start, first we need to understand what exactly funds is, then the types of funds, how they are managed, and risk and fees. And last, final conclusions. Please watch till the end. Your time will be worth full. Before we dive into the topic, I would like to inform you that this is not any kind of financial advice. Let's dive now. Before we understand types of funds, we need to understand what funds exactly is. Funds. Basically, funds is not single or individual person's money. Funds are the money collected from many people. For example, your whole friends are organizing a birthday party. Your every friends, including you, started pulling their money. For buying birthday stuff such as drinks, cake, balloons, etc., these money or funds collected by you guys. Called funds. When a group of people pull their money for an investment like stock, bonds, or real estate. That is called investment funds, because the purpose is investing in a variety of assets. I hope you understand what funds is. Now move forward to the topic. Types of funds. Starting with index funds. Probably the most talked about on social media or by influencer. They said just put your money into index funds, let it grow and forget about it. What does it mean? Then who will manage my funds? What if market crash? Hold on and keep breathing. I will tell you everything. What does it mean? Index fund is not a stock. As you can see, answer in the name of itself. Index fund. Look, do you know how an index looks like? Exactly. Kind of a huge list. Yes, but this list is not as your notebook, but because this is an index of stocks. In this index has listed many companies. Yes, index funds is a huge list of companies or stock. You can say it works like an indicator. Of course, not like a car or motorbike. That show left and right. But the indicator that shows how the list of companies or stocks in the index funds are performing. It is like an indicator, but there are many index funds, literally. But the famous one is S&P 500. Yes, this is an index funds. Is that means S&P 500 has also many companies listed? Exactly. How many companies are listed in the S&P 500 index fund? Look, the answer is in the question. Wait, what? Yes, S&P 500 means this index funds has listed 500 big companies. Then what are they? In the top list of the S&P 500 index is listed NVIDIA. Then the Apple, Microsoft, Amazon, Meta, Tesla, many more, etc. S&P 500 all listed companies are stock link in the description. Because you invested in index funds. So now your investment spread across the whole index list. Mean you even invest less, it will diversify into whole companies that listed on index. For example, you invested your $1,000 money in S&P 500 index funds. Now your whole investment that is $1,000 will diverse or spread into those all company or stock which are listed on S&P 500 index. Because S&P 500 index has listed 500 companies, so your money automatically will invest into 500 companies on list of S&P 500 index fund. There are many kind of index out there. Based on category, like Nasdaq, it tracks 4,000 companies in the USA. This index tracks major technology sector, software, hardware, AI, internet companies. This index includes big giants like Apple, Microsoft, and Amazon. Nasdaq is performing well from few past decades. Dow Jones or Dow Index. It shows how 30 very large and famous US companies are performing. Includes only 30 companies. Companies are industry leaders. Examples: Apple, Microsoft, Coca-Cola, McDonald's. There are many index for specific sectors for small companies. International market, emerging economics, healthcare, energy sector, they are following index. That exactly is good things because they keeps the fees very low. You are not pay for the managers, but for the system. The fees name called expense ratio, it's usually between 0.02% to 0.20%. Means if you invest $1,000 in index, you might pay just between 2 cents to $2. Index funds are passively managed. Index funds are managed by big investment companies. not by governments or stock exchanges. Main companies that manage index funds are Vanguard, BlackRock, State Street, Fidelity. These companies are called asset management companies, AMCs. AMCs collect money from investors and manage it professionally by investing in mutual funds, index funds, pension and investment products. That means you don't have to worry about market, as you can see on your screen. Even if a company does not perform well, then the other companies can cover the loss. That's why index fund is safe. It won't ruin your whole investment. It may reduce your return profit. Where you're getting 15% return, you may get 12%. Just this will happen if some company does not perform well. Also, the index funds are different than stocks, especially in buying or selling. Unlike the stock, you cannot buy or sell anytime. You can only sell or buy index fund once a day. This time no is cut-off time. Here why index funds are so popular. Simple, it's very low cost. Low efforts. That means you don't need to stocking your funds. And it's performing very well over the long term. That's why a lot of biggest investors and even Warren Buffett chose index funds. All right, let's dive into mutual funds. Mutual funds at the first look seems as index funds. They pull money from many investors and spread into assets like equity market, means the stock market, bonds, and golds. The main difference is that how they are managed. Mutual funds is actively managed by professional money managers. They are actively manage your money. They decide what stocks to pick or throw. If any stock doesn't perform well, they will throw the stocks from the list. But look, there is many types of a mutual funds. Basically, it's based on where they are investing your money. If they invest your money into stock market E, called equity funds. If they invest your money into government's bonds, called debt funds. If they invest your money into both means into equity funds and debt funds, called hybrid funds. But it's all up to you. You can choose whatever the type you want. If you want high return, you can choose equity market. If you want low risk, you can choose debt funds. But if you want averages, return, low risk, and stability, you can choose hybrid funds. Your money will spread into both equity funds and debt funds. Equity funds for growth. Debt funds for stability. You can watch my another video in detail about mutual funds. Click on I button or go to description. Let's move to ETF funds, or exchange-traded funds. An ETF is kind of a big basket of stocks, bonds, gold, etc. As you can see, the name ETF means exchange-traded funds. That means a funds that is traded on an exchange. Yes, it is traded on exchange, such as stocks. Is that ETF is stocks? No, absolutely not. It is a huge basket of many assets such as stock, bonds, gold, but it seems as index funds. Let me clear your doubt. Unlike index funds once a day, but you can trade ETFs anytime. You can buy whenever you want, or you can sell them whenever you want. Like stocks. ETFs need a demat account because they trade like shares. Index funds don't need demat, but your order is executed at the day's NAV, net assets value. If you invest before cutoff time, the NAV is decided after market close. But in the ETFs, it is same as market price. Expense ratio. The main advantage is that the expense ratio is even lower than index funds. Final conclusion. Who should invest in index funds? Index funds are best for beginners, long-term investors, people who don't want stress, people who don't want to track markets daily. Low cost. Automatic diversification. Very good for wealth building over 10 to 20 years. Not ideal if you want quick profits. You panic during market crashes. Who should invest in mutual funds? Mutual funds are best for people who want professional management, investors who want different strategies, those who don't mind slightly higher fees. Actively managed, more flexibility can outperform index but not guaranteed. Not ideal if you want lowest possible fees. You blindly trust fund managers who should invest in ETFs, stock market traders, people who already have a demat account, Investors who want full control in live prices. Very low expense ratio can buy/sell anytime during market hours. Not ideal if you are a complete beginner. You don't understand market timing. Simple. Index funds for simplicity, mutual funds for strategy, ETFs for flexibility. I hope you understand now. Thanks for watching. If this video cleared your doubts, please like the video and subscribe to the channel.